Ladies and gentlemen, good day and welcome to the earnings call of LMW Limited for Q4 of financial year 25-26 hosted by NSDL. As a reminder, please note that the participants' line will be in listen-only mode and there will be an opportunity to ask questions after the brief by the company officials. Should you require any assistance during the conference call and raise questions, please signal the operator by raising your hands. Please note that this call is being recorded and this is Himani from NSDL. We have with us Mr. V. Senthil, Chief Financial Officer, and Ma'am B. Dhanalakshmi, Associate Vice President of the company. Over to you, sir.
Thank you. Thank you, ma'am. Very good afternoon to everyone, and thank you for joining the LMW's earnings call. We will have a brief about the overall performance of the company for the year ending March 26, followed by an interactive session. I would like to clarify that certain statements made in the discussion during the call will be forward-looking in nature. To begin with, let me explain the overall performance of the company. Then we'll go into segment-wise and consolidated performance. The financial results have been posted on the company website, and I hope you had the opportunity to go through the same. The revenue for the year ended March 26 stands at 3,082 crores as against 2,909 crores for March 25, which is an increase of 6%. And for the quarter ended March 26, the revenue is 854 crores as against 767 crores during the previous quarter of December 25 and 789 crores for the corresponding March 25. PBT for the year stands at 221 crores as against 155 crores for the previous year, which is an increase of 42%. There is an exceptional item of around 11.5 crores and 1.68 crores during the year and period ending March 26, which is a one-time impact on account of new labor code and VRS outgo. Now going into the details of the division, TMD revenue stands at 1,801 crores for the current year as against 1,840 crores for the previous year, which is down by around 2%. For the quarter ended March 26, 485 crores as against 440 crores during December 25 and 493 crores during March 25. Profit for the division is at 9.75 crores during the year compared to a loss of 15.64 crores during the previous year. With respect to the order book, currently we hold an order book of 3,300 crores, of which the active orders are around 2,300 crores. With respect to sales, which has been clocked during the year, the ratio of domestic to exports to spares stands at 66:8:26%. With respect to LMW Global, the turnover for the year stands at 184 crores as against a comparative number of 146 crores for the previous year. For the current year, the loss stands at 32 crores as against a profit of 1.9 crores for the previous year, and the order book stands at 44 crores. In LMW China, for the year, this turnover stands at 130 crores, and for the comparative period last year, it was 67 crores. There is a break-even during the current year as against a loss of 6.8 crores during the previous year. The order book in China stands at 120 crores. Now, with respect to Machine Tool Division and Foundry, the revenue in Machine Tool Division and Foundry stands at 1,205 crores for the current year as against 1,003 crores for the previous year. Out of this, around 10% relates to Foundry Division. The balance is towards Machine Tool Division. With respect to ATC, the revenue for the current year is rupees 207 crores for the current year as against 169 crores for the previous year. At a consolidated level, the revenue stands at 3,353 crores for the current year as against 3,137 crores for the previous year, and profit is at rupees 195 crores as against 151 crores during the previous year. With this brief, I would like to continue to the interactive session. Over to you, ma'am.
If Anyone wants to ask the question, then you can raise your hand. We have with us Mr. Hemang.
Good afternoon, Mr. Hemang. Please go ahead.
Yeah, good afternoon, sir.
Yeah.
Yeah. Sir, my first question on the textile machineries side, what is the current scenario of yarn spreads are improving? So, how you see the order book pipeline going ahead, and what is the level of inquiry in Indian market and especially global as well? My second question on machine tools division. So this time we saw 25-28% of turnover growth in MTD division. So how you see the next year in terms of the revenue growth for the machine tool division? And if you can highlight on the ATC division as well, what is the active order book and the timeline of executing that order book? Thanks.
Thank you. Mr. Hemang, with respect to the textile scenario and textile machinery division, the industry has been doing much better in last 2 months from a cotton point of view and a cotton yarn point of view. There has been challenges on the synthetic where the synthetic price because of the crude because again, on account of the geopolitical issues, the crude price has been very volatile. There's been challenges on the crude based synthetic fiber and then subsequently the profitability on that. But with respect to general, the cotton spinners and the profitability has been good. The spreads have been good, hence the profitability has been good. We have also, if you look at the order intake, we have actually got a significant increase in order book compared to the last quarter. What we have declared, the current order book stands at 3,300 crores. And all these orders were brought in during the last intake during the quarter four. However, the outlook as far as domestic is concerned, it looks positively good. Utilizations are good. We would anticipate that going forward, there will be much larger offtake of machines, much more offtake of machines. And we have even said that almost 24 months since the slowdown has happened in textile, this is something which we were looking forward to. In fact, in the last call, we did mention there has been a consistent slowdown and we were anticipating there's a pickup. Of course, the impact of the geopolitical and the crude price has impacted in a lot of changes in the market. So what we see is a lot of yarn is going into Indian yarn is going into China, because of which we are also seeing good markets like Bangladesh, where we have a significant order book from Bangladesh. That those markets are getting reactivated, including Turkey, which has been very, very dull for quite some time because of the high interest costs, etc. There also, because of the current issue on the synthetic, the cotton yarn producers are becoming active. They are modernizing, and it is slowly starting. I wouldn't say it is back to where it was in the past, but at least it has started slowly. So from overall scenario, which we had to see between last January and post the war conflict, which has kind of started, and the impact that is having from a textile spinning sector, it has kind of helped with the cotton spinners and the cotton yarn. Whilst, like I said, the synthetic is going through some bit of challenge. The synthetic yarn producers are going through some bit of challenge. Also, the fact that the tariffs have been rolled back, that is another point, and the FTAs have come in. So overall, it looks to be a very positive outlook over a period of time from a textile sector. Whether this would be a hockey stick recovery kind of what we have seen in 21, 22, that is too early to be mentioned. Having said this, we should also be aware that the cost increase which is happening right across the industry. We are also impacted because of the increase in logistics cost, increase in costs of raw material, plastics, commodities like steel. So that is something which we are keeping a very keen eye on, and how do we kind of overcome this, or as we move forward, is something which we are continue to work on. This is with respect to textile industry, textile segment. With respect to machine tool segment, yes. In fact, last quarter, we would have seen a significant growth in terms of the turnover. It is continuing to grow. Machine tool division is continuing to do well. The ratio of the segment which we are addressing from a customer point of view continues to be 50% dominated by automotive, 50 to 52% is dominated by automotive. The non-automotive business continues to be around 48% from a segment from segmentation point of view for the machine tool division. We are definitely seeing good traction on the defense aerospace side of the business, and we have always maintained, I think there is significant runway for growth in this particular business. And as far as our capacities are concerned, even with the current shipments, what we have seen in Q4, still we continue to maintain possibility to grow by another 20% because we have of all the capacity additions what we have done in the past. So machine tool division is seeing traction. We are also seeing traction on the machining centers, which is vertical machining centers, and also some amount of horizontal machining centers. With respect to ATC, we have been able to clock 195 crores. Our order books, like last quarter we mentioned, it is not significantly moved. It's around 360 odd crores, which needs to get executed over a period of 1.5 years, 18 months. And we are continuing to maintain that order book. We have not seen much new orders which has to get executed in a short period of time coming during the last quarter, but outlook continues to be positive. We are also adding capacities there. In fact, if you have seen the financials this year, almost 50% of our capex has gone into ATC for the machinery purpose. So yes, we are adding capacities there. All these capacities will start yielding higher turnover probably once they come into production, probably in the second part of the current year. I think this would basically answer your questions. Over to you, ma'am.
Yes, sir. Thank you very much for the detailed answer.
Thank you.
Thank you so much, sir. Next, we have Mr. Sanjay Shah. Sir, we have unmuted you. You can please ask your question.
Yes, sir. I'm audible, sir? And
Yes,
Yes,
yes, Mr. Sanjay, please go ahead.
yeah, thanks for opportunity, sir. So my question was continuing our ATC division is still small, but it has a very highest margin profile. With Q4 revenue of 56 crore, segment result and 11 crore, and margin close to 20%. For FY26, ATC revenue grew by 206 crore and segment profit by 20. Could you explain the nature of this business in more detail? What portion is across or the precision component? What is the customer qualification cycle, and what milestone should investor track to assess whether ATC can become a materially larger profit pool for our next 3 years?
Any other questions, Mr. Shah?
Yeah, one more question was on UAE investment. The board has approved an investment of to US dollar 30 million in a holding company UAE. So for working capital, the subsidiary which is doing around I think 18 crore of top line. What is the rationale and what expected revenue opportunity and payback period as a management you feel?
Yeah.
That's all from my side, sir.
Thank you. I think thank you for the question on ATC. I will take a bit of a time to explain what we do with an ATC. In ATC, we have two divisions within ATC. We call it the metallics division, and second one is a composite division. Within metallics division, we have engine parts, we do sheet metal, we do structural, we do assemblies, and we do special process. And the predominant feature of our ATC division is it is concentrated, almost 90% concentrated towards exports. This has been the business. And with respect to composite, whilst initially we have brought in this facility and this expertise and this diversification from metallics into composite was mainly towards the Indian space program. In fact, if you look at the literature, what has been published in the past, the nose cone, the PSLV launch vehicle, the entire the nose cone which houses satellite, which is basically a 9 meter by a 4 meter part, is done at this facility and in composites. So the flavor for ATC is absolutely, like you rightly said, the precision engineering, and that is on both on the metallics and the composite side. The effort what we put into the metallics is that we are suppliers. We are either we are tier 2 suppliers to some extent. We are tier 2 suppliers in the supply chain, and there is a vast amount of orders which we can take. We also ensure that we are able to pick up only those highly technically challenging parts for us, and that's where you see a little bit of a higher margin, because the parts what we do are not regular run-of-the-mill parts. They are technically challenging parts, and we bring together the ability to have both composite and metallics within the same workshop. Right, so when you get a part which has to have both composite and metallics, it is much easily done by us. From the composite side, what we have is a very large facility, like I just explained. So right now we are also going into the composite part requirement of the existing customers who are on the metallic side. They are technically the same customers, so we try to increase our wallet share with the customers, trying to provide a lot more value added and little bit more of a service to the customer. Like I said, we have seen the turnover of 195. Our order book, what we just now mentioned, is around 360, which has to get executed over a period of 18 months. The only challenge when it comes to ATC as a division is the fact that these orders are all actually long-term orders. They do have a visibility. They give us a visibility of 3-4 years when they actually give us the orders. But the only challenge there in certain times is there is a push out or a pull in. That's the way the business works, and we have to work with that risk. It is a highly intensive, working capital intensive business, because the raw materials are all sourced from abroad. And you can see that again in our segmental results, the working capital requirement is quite high in the business. And that's but that's the way the business is. So we have to have working capital. We have visibility of orders. We take up very high precision parts, and that's the way we increase the business and increase the wallet share. Yes, we have done 3 different things. One, whilst we have always started in the past with metallics, 4 years back we have invested into composites. We have expanded into composites. Our composites offtake is as a utilization would still be closer to 50%. So there is enough capacity for us to go on the composite side. On top of it, we have just mentioned to the previous question that our investments have continued into ATC business, and it will continue into the ATC business as we see a much better traction. We have also mentioned in the past that we are trying to put a new facility for the ATC business because the current facility as what we have it is a little bit smaller. It is in middle of the town, and we have to move it out of town, so it will definitely become a larger facility. This is the runway we have for ATC division. Whilst we can't give you numbers what we are going to be in X period of time, but definitely there's the intention to expand the infrastructure, and the decision to continue to invest in machinery is evidence enough that we continue to grow in this. With respect to the investment of 30 million, currently the company there makes 180 crores, and the requirement is that this 30 million goes not just to the working capital. Working capital is one portion of it. The idea is to also explore potential growth opportunities from there. If you have seen in the past, our export has always been closer to 600 to 700 crores has always been our export market share in the past. And the only place to grow both for our textile machinery division and machine tool division is the export market. And we have been there for 2 years in GCC countries. And we find, for example, in machine tool division, the demand for machine tools has been interestingly quite high, and a lot of what we call turning centers has been a quite high demand. Where we were at no turnover on exports, we have actually clocked, I would say, closer to around sub 20 odd crores on export of these machines to this particular location. So like that, if you had to see, there is a huge potential for us to grow on the export side, and that is what we would like to capitalize on. On top of it, the current geopolitical situation has put a lot of pressure on the working capital, the bank's ability to fund working capital for us, and that is something we need to immediately support on this. These are the reasons. And of course, we are looking at a return over the next 3 years where we can build an equally strong and a large export portfolio, which we had in the past at around 23 to 25% of exports. We would definitely like to build on the export side. Thank
That's
you.
great.
Back to you.
That's great. With your permission, can I squeeze one more balance sheet related question?
Oh, please go on.
Yeah, it was regarding the since such a prudent management and such a wide visionary, how can you elaborate on improving our ROC from current level, from all the divisions ramping up and getting a good modes after treasury income, when you see that our company going to a reasonable ROC metrics?
Definitely, I think we are working on it, Mr. Shah. We are definitely working on Ms. Sanjay Shah. Yes, Ms. Sanjay Shah, we are definitely working on it. I think see, this business is a little bit cyclical, right? I think we'll have to understand two portions of textile machinery business. Textile machinery business is heavily cyclical. And if you actually trace and track our numbers over the last 24 years, you would find an 8-year cycle coming through this. We are in a very low down cycle, 24 months of absolutely very, very challenging period. And the machine tool has only now started. And so if you had to actually split up this division wise and look at it, of course, you would find an ATC at a much better ROC, MTD will do better. But from a textile machinery point of view, it is It is bit capex heavy, it is cyclical, but we will definitely get there. We have got plans, we'll definitely execute and get there. You should also understand how the business, if you look at our business, our bill of material for each machine might go up to 20,000 parts. The amount of the complexity in the business is not is quite interesting. I would say interesting. That's why it is when it is cyclical, we have to tighten our belts, make sure that we are positive on cash. We invest, we continue to invest, especially during the downtime, whereby we are able to capitalize during the upcycle. Okay.
Very helpful, sir. Thank you very much, sir. Best of luck.
Thank you. Over to
Thank you
ma'am.
so much, sir. Now the next person we have, Mr. Ritvik Sheth. Sir, we have unmuted you. You can please ask your question.
Hello. Hi, sir.
Good afternoon, Mr. Ritvik. Please go on. We can hear you.
Hi, sir. Good evening. So, couple of questions. So, firstly, one clarification. Order book in TMD, you mentioned it is 3,300 crores, and active order book is 2,300 crores. Just wanted to see whether I've heard it right or not. Secondly, in the opening remarks, you mentioned that the raw material cost has increased across the board. So can you give a sense, what kind of price hike you will have to take in the textile division and the machine tool division to offset this raw material? And thirdly, in the machine tool division, so what is the total imported content for the raw materials for LMW? And are we looking to source it domestically or, do some backward integration on that front? So these are my three questions, sir.
Yeah. With respect to raw material, yes, the prices are going up. Everywhere the prices of everything from logistics to commodities to availability. In fact, the larger challenge is even if you pay the price, do you have things which are available? I think all of it comes in, but it is also prudent from our side not only to look at passing it on to customers, but also look at what we can do. So yes, it is something which is the discussion or the topic of the day, as you might call it. That this is something which is getting discussed and where we are acting on it on a daily basis, both on looking at how we could save out of it, what we could save, and there are a lot of things we do on this. Passing on, we can't anyway tell you how much or what we are planning, and that's not something which can anyway share with you. With respect to order book, yes, you heard it right, and that's what I mentioned, that the order book stands at 3,300 crores, and that has been an increase in the last quarter. Compared to the number which I had given in the previous quarter, in the January call. With respect to the import content in machine tool division, it's around 50% of the material would be imported. But again, we'll have to see that when it is imported, some of it is imported, but we do source it locally with the Indian currency, where it is denominated in Indian currency. And there will be some of it which is sourced directly, which is pegged to the US dollar. When we say imported, it would be imported but sourced locally. Very important question which you have asked. Can we localize what we are importing? You touched the Make in India question here. Can we make whatever we are importing here possible, but it is not something which we can switch immediately. It is not something where it is available, and because of even with availability, we are not importing it. It is just because to ensure good quality and items are not available, and then it has to meet our standards of what we deliver to a customer. Only in those cases we definitely look at importing. these items. And most of them, even if the branded, they are trying to our supply chain is also trying to source it, rather assemble it or make it locally as well. Quite a few of them over the last decade or so who have started localizing the supply chain. Having said that, it doesn't remove too much of a risk, right? I mean, today, absence of whilst we all know about absence of LPG because it impacts everyone, absence of certain other gases which are used in production is also impacting. And we are working, our supply chain team and also the production teams are going constantly to see how to reduce use of these, products which do not, which is not available very easily. And there's a lot of things being done on a very active basis. Yeah. Thank you.
Sir, just can I squeeze in one question?
Yes, please.
Yeah. So MTT division has seen good profitability in the current quarter. It is at a multi-quarter high at around 11.5% EBIT. So this run rate would be sustainable going forward in FY27. And also one thing is that would we have taken any price hike in the last couple of months or couple of quarters in MTT division?
No price hikes in MTD division, and some portion of it, I think you may is on account of the slight forex income which has got booked there. But however, we have maintained that when we cross the threshold, because we got enough capacities. If you see, we have kind of built capacities. We were at close to utilization at 65%, 70%. So we had enough capacity to go up. So what you're seeing is pure operational, the margin which is coming through because of consistently doing upwards of 100 crores or 300 crores per quarter. So this we would expect this to continue. And as the turnover goes up, definitely to have this. But again, when we see that we are reaching a number which is very close to our capacity, then we would continue to invest to grow that.
Got it. So this is helpful. Thank you and all the best, sir.
Thank you, ma'am. Thank you. Back to you, ma'am.
Thank you so much. Next person we have Mr. Divyam Doshi. Sir, we have unmuted you. You can ask your question, please.
Hello, sir. Very good afternoon. I have two questions. The first one is on capacity utilization. What is our current capacity utilization and how much are we actually utilizing? And is there any additional capex required? And the next question is that for our ATC business, so our ATC revenue has always been good, right? But the company has never named the customers or programs or any certification that it possesses, like the AS 9100 certification that is generally required for an aerospace company. We have never named it. So who are we actually selling the products to? That was my two questions. Thank you.
Okay, I think the capacity utilization is something which we can share, but customer names and the projects would be difficult. But anyway, see, for us, the capacity utilization on the textile side would be somewhere around 50-55%. On the machine tool side is around 70 to 75% is what we currently are utilizing. With respect to ATC, to be in ATC business, to my count, we require 19 certifications, right? I mean, apart from AS standards or ISO standards, your NADCAP approvals. So there are, for us to sell to customers, we need this. And there are also customer specific certification, which is also required. So your the Boeings and the Airbus of the world would expect you to have their certification also, if that is so. With respect to who we sell to, like we said, we sell to customers who our customers are sub suppliers, or rather suppliers, tier 1 to the aerospace companies like Boeing, etc. So that's what it is, and we also supply to Indian space program, so ISRO, HAL, and all the defense. We also supply from ATC division.
Okay, sir. And on the capex side?
Capex side, okay. From a textile machinery and machine tool point of view, we would, like I mentioned to the previous question, as we scale and reach a capacity utilization which is closer to 90%, we would then continue to invest in that particular business for us to keep that gap of for us to grow. So machine tool division, as of now, we did invest the year before last year and the year before last. We had invested continuously for 2 years, and in fact, if you look at our capex investment over the last 4 years, it would have been quite significant. Around 300 plus crores has been the capex investment last 3 years. So this has all gone in at a time where we were hitting that 90%, and we had to also modernize these machineries. We have done that. But for ATC, like I already mentioned, yes, we will continue to invest. This year also we have invested, and we will continue to invest. There in ATC, we have to not invest for capacity, but we have to invest as we get orders, because there it becomes important to deliver on time. So as we get more wallet share with the customer we work with, then we will invest for those projects. It are more project-specific investments. And that we continue to do so as and when we win projects.
Okay, sir. Thank you so much. That was really helpful.
Thank you. Over to you, ma'am.
Thank you so much, sir. At this moment, we don't have any hand raised. Okay. So next we have Mr. Suraj. Sir, you can please ask your question. We have unmuted you.
Growing at 50-100%, and since you are long present in this division, like, do you see such demand in aerospace from be it Airbus, Boeing, or any tier 1 suppliers?
Suraj, we missed your full question. I think you are on mute. I could only hear the second part of it. Can you repeat the question,
Yes,
please?
sir. What I meant was, like, in aerospace division, especially in India, we see like many companies winning orders left, right, and center. Like, companies are growing at 50 and 100% because of Airbus and Boeing and other tier 1 suppliers outsourcing them to India. So do you see such demand going forward in the ATC segment?
Suraj, absolutely yes. I think to the addressable market size in ATC from even if you take the market size towards aircraft or market size towards the defense industry, and for us it is both, right? And it is in probably it's trillions, and we are looking at very small number as to what comes to India for manufacture, and we are part of that ecosystem. Like I said, we are definitely looking towards more and more business from the customers. In fact, I also mentioned that our exports constitutes almost 90%. And that is where the entire ecosystem is supplying to. So there is immense potential, no doubt. But our process of how and what we choose to supply is very important. And that is where we try to choose to supply only those parts which are technically challenging so that we are able to maintain the engineering, the skill in engineering at a much higher level. Like I said, we are one of very few facilities which also bring together composite and metallics together. So there are certain processes which we would like to be part of. We don't envisage this to be something where we would just get into everything, and try to supply everywhere. Like I said, we have our own segments within this: engine parts, composite, sheet metal, structural assemblies, and special process. So this is something which we would like to grow within this segment. To answer your question very clearly, yes, there is immense potential, and that is where we also mentioned that we have taken a call to grow the infrastructure for the company as well. So we are trying to build a new facility for ATC, which will be much larger to the current facility. So these are all plans for the future.
Right. And there, sir, you have, I think you have announced around 150 crores of capex for ATC over next 5 years, right? Which can give you potentially 300 crores of revenue, right, in this
So
segment.
this capex was going towards our infrastructure to start with. Then what comes inside that? So that's after that. So we would have facilities which would be much larger than what we currently hold, and within those facilities can scale more than the 300 crores what you asked for. This cost what we mentioned was towards the infrastructure build.
Oh, it's nothing. It doesn't include anything on machineries.
Machineries will be add on after this.
Okay. So, sir, basically, can this business scale to 1,000 crores in 5 years? Like, can that be the potential opportunity for LMW?
The opportunity is definitely there, but we don't give out numbers as to what we will do.
Got it.
Okay. Thank you.
And thank you.
Over to you, ma'am.
Thank you so much, sir. Mr. Hemang has a follow-up question.
Yeah, please go on, ma'am.
Sir, we have unmuted you. You can please ask.
Mr. Hemang, you're on mute, Mr. Hemang.
Yeah, sorry, sir. So what was the breakup of revenue in ATC division for composite and metallics for the fourth quarter and financial year 26?
I mean, I would probably give you overall number. It's around 20%. You can take 22% you can take as composite, and 78% is metallics.
Okay, sir. Thank you.
Thank you.
Thank you so much, sir. At this moment, we don't have any hand raised. Sir, shall we conclude?
If there's no hands raised, then yes, ma'am, we can conclude.
Since we have no raised hands further, this brings us to the end of all the questions from all the attendees. Thank you so much, everybody, for joining us, and especially thank you so much, Senthil sir, for answering all the questions asked through the entire meeting. Thank you so much, sir. Thank you, everyone.
Thank you. Thank you, everyone.